Hey, good evening, fam. Good evening. Hope all is well with everybody. Hope all is well with everybody. Hey, listen, I want to take a quick moment today, and I'm not going to be long winded with this one. It's just something that I've been noticing a lot when I go into homes, right? And especially homes with people that have mortgages, right? Two things I'm seeing is either a person have a mortgage and they don't have a mortgage protection plan or life insurance per se, and two, if they do have one, it's not structured properly. And what I want to go over today when I say structured properly is like really a mortgage protection plan should be able to do at least two out of three things, right? But mostly three things. Depends on which kind of mortgage protection you have. Okay, if it's a term plan that you use for mortgage protection, it should be able to cover at least two things, which we're gonna go over. If it's a IUL or whole life is what you have, I prefer a IUL because of the third reason that I'm gonna go over. It should be able to cover three things, right? So let's just dive into it. A mortgage. So what mortgage protection is? Let me define that first. What mortgage protection is it's pretty much coverage on your property. It's on you actually, but it's in the event that you pass away, your responsibility get paid off. Okay, which is like your mortgage. Okay, so it's pretty much insurance coverage on you because you're the breadwinner. You're the one going out and making the money to be able to cover this mortgage payment, right? So you want to make sure that something happens to you, that your family, your wife, your children still have a home that they can reside in, especially if it's taking two income to be able to maintain this property. You want to make sure that if one party goes away, then they can be able to maintain the property, right? And let me go over because I think people need to know the data to understand what's really going on, right? 50 to 60% of foreclosures are linked to the death of the breadwinner. Let me say that one more time. 50 to 60% of foreclosures are linked to the death of a breadwinner. Listen, I'm in the DMV. The average home right now, you're probably going to pay about $3,500 to $3,800 a month mortgage on the average. Okay, most individual cannot handle that on their own. So it's usually two income, that people are able to survive. Because remember that is that's just the mortgage. We're not talking about utilities. We're not talking about the maintenance of the property. We ain't talking about all of that. So most people will not be able to pay that on their own. So if one person passes away, it now becomes financially stressful for the person who's still alive. Okay, 40 to 60% of foreclosures are linked to illnesses. Okay, which means somebody falls sick, they don't have enough money saved up liquid to be able to pay mortgage payment as due, and the property end up going into foreclosure. Okay, so if you have if you don't have any policy at all, you need to get one right away. Okay, if it's a term policy, your term policy should have what's called living benefits, right? That's tied to it. Most people that who are out here only have a term policy, for example, that covers if somebody passes away. That's it. But what if the person falls sick? They don't have that. So when I say if you have a mortgage protection plan, your mortgage protection plan should cover those two things at least. If somebody passes away and if somebody falls sick. Okay? Now, the last one I want to talk about though is your mortgage protection plan should be able to allow you at some point in time be able to help with paying off your mortgage sooner than later. So for example, if you open up, for example, a IUL, for example, and you're funding it properly, right? 10 to 15 years later, because remember, you're still paying your mortgage while you're paying this insurance premium, right? So you pay down your mortgage, for 15 years or so. 15 years later, you can now look into your life insurance policy and see if you can extract funds from there to now cut a full check to the mortgage company, and your mortgage is paid off. Okay, why is that a benefit? If your mortgage is $3,500 a month, and you're able to pay it off in 15 years instead of 30 years, you now can take that extra $3,500 and now start to pump it more into your retirement. So, for example, let's say you bought your house, you were, let's say, 40 years old, right? Now you pay it off at the age of 55, right? Now you're now taking that $3,000 that you're paying every single month and pumping it now into your retirement income. You can now retire with a significant amount of money. Let's say by the time you're age 60, let's say 63. You understand? So the mortgage protection plan, the way I structure it for my clients, is going to be is in most cases 99% of the time is going to be is covering those three things. One, if somebody passed away, the family's going to be okay. Two, if somebody falls sick, the family's going to be okay, and that person's going to be okay. Okay, and then number three, ultimately, if none of those things happen, you can actually pay your mortgage off sooner than later, which gives you freedom. Okay, and which also loosen up some money, to the family that they can now use to invest and actually grow their wealth even more. All right. Listen, if you guys have more questions about this, or you want to sit down and go more into detail about mortgage protection plan and make sure that it's structured properly. Oh, and also last but not least, because I see quite a few mortgage protection plan that is not properly structured, and it dies out early because some of these agents don't really know what they're doing. Okay, so if you're interested in learning more about this, or you want to review your plan, make sure, hey, what you have is going to do the job. Okay, please feel free to text me at 443-208-5480. That's 443-208-5480. Listen, I look forward to hearing from you. Have a wonderful and blessed rest of your day.